All right, so let's go over the indicators one by one, and let's put them together. Okay, I'll move the questions over, and I'm gonna show you some tricks that I use that are gonna be very, very helpful for you to trade. But first, let's take the indicators one at a time. Now, I was gonna take the whole workspace apart, but I'm gonna go into here, and the first thing we're gonna do is we'll look at the simpler indicators. Then the first one we're gonna look at is, I think, is one of the most important. It's the trend line. Now, I don't want. Why don't I do this? I mean, I'm going to remove everything. Because I have the template, so it doesn't matter. And I'm just going to leave the trend in. I shouldn't have. Now, I removed a little too much. I have to, which I'll put back. Whoops, just removed everything. Let me close it, and let me go back. Now the modified fast and slow stay. And let me just remove and the levels. I'll leave the bar closes. EMA analytics we can remove. The bias, the continuations, order flow. We'll leave the volume. And the modified gear. The trend is the one that I want to show. The channels. Well, the Keltner channels we don't use. We just do it to center the chart. And I'll show you how that works. So let's hit OK. And this is our entire chart now. Now there's nothing to load, and there's no candle halo. So what we're looking at is market structure. Now, optimally, in fact, one of our hard and fast rules is we only trade short when we're below the 50, and we only trade long when we're above the 50. I mean, just by definition, we decide that when the market's below the 50, the bears are in control. When the market is above the 50, the bulls are in control. Now, this line is an exponential of an exponential. It's a 50 exponential of a 50 exponential. And it moves smoother and just as fast as a 50 exponential. And it shows you the slope. This line, and what I'm going to do is I'm going to put a regular exponential up against it, is an exponential of an exponential. And we'll just put up an exponential, an EMA. It's a 15. I'll make it a little thicker. And you see how they don't move exactly the same? The EMA gets jerked around more by price. You see how it gets bumped up here? But our EMA of our EMA is smoother, but it moves just as fast. And you see how this movement up takes this gold line and pushes it up, but our line stays a lot flatter. That's the property we've given it. It moves just as fast, but it doesn't get buffeted around by price as much as a normal EMA does. But you see how this moved down? They converge and move down with just as much speed. But look at this one candle up. It pushes the EMA up. These three candles up push the EMA up. But the EMA stays a lot smoother here. So it tracks price a lot smoother and I think much better. So let's take that off. We developed that ourselves, and you're not going to see this kind of EMA anywhere. All you're going to do is going to see the standard EMA. Now, this is the only indicator in 9 years that I created 9 years ago that's still with us. Almost everything has gone through an evolutionary process, and that's part of applied mathematics, where you look to optimize your trading software. If I showed you the workspace when we first started at the end of 2012 and what we're trading today, everything is radically different. But this line is the same, and it is a key line. And if you don't take information off of it and trade it appropriately, you're going to wind up with a lot of losers. And it rarely will hold you up on a winner. Now, what it is it's a combined assessment. So it's a 15 an ADR, ADX assessment. Now, ADR, ADX is an assessment of volatility. And I think you can get it in Ninja as a symbol. So there's the call it the ADXR, which it's probably about the same assessment. What it's doing is assessing volatility. So you only want to take a trade off start when you have volatility, because volatility is what creates significant movement. Now, if you're on a 2-unit Renko, our first target on the E-mini is 6, and our second target is 12. We have traders in the room who are scalpers. We're not scalpers. We only want to take a trade that we know or we feel when we take it is going to go 12. We're not looking for 6. We're looking for a full winner, because on every trade, we have the potential for a full loser. So you want to take a full winner. So you want to take a trade like this. Now you can see it's just come off an area of low volatility. And remember, there's high expansion, there's expansion and contraction, expansion and contraction. So right here, volatility falls. And we look for volatility to explode out. Now, one of the keys to the indicator is that it separates from the 15. And you want at least to take a separation. A little bit of a risky entry right here, because they're almost right on top of each other. And that's a little bit of discretionary trading. If you want to trade safer, you see this wick, you're going to trade this pullback, because here you have the separation, and you're going to take the trade short there. It may have cost you, but our goal is to eliminate risk. And unlike most day traders and swing traders whose primary goal is to get winners, our primary goal, which I failed yesterday, was to avoid losers. Like, if you can get 3 and out, you take it and run. If you can get 3 out of 4 trades and you're up over 400, you leave. So you want to take the lowest risk potential trades on the chart. So we look for a pullback when the trend has separated from the 15, and that shows that there's significant volatility present in the market, and it helps guarantee that we're going to get a winner. Now, why do we take a pullback? And that's because you're retracement traders only, and we always look to catch traders in the counter trend direction. That really is part of our core methodology. So if we get a wick here, any wick in this market is a bull failure. The bulls tried to push this trade all the way up and created a upper shadow, a wick here, and they failed. So we know that there's a significant number of buyers in this candle. And when the candle continues to the downside and we run those buyers over, it's going to guarantee we get follow through. That's why we just don't jump into a trade. Because although we're trading in the direction of institutional money, and when we put it all together, I'm going to show you why. It's the kind of alignment that really only big money can create. There's always a bunch of joker retail traders that'll create this one-up candle. And we don't want to jump into a trade because we can jump into it right before we get a reversal candle and then the continuation. Let's let the buyers have their say first. Try to turn the market and fail. Then we're going to take it lower. Now that's why this kind of setup is so great. Now I'm not looking at background bias. I'm not looking at anything else. We're just looking at 50, the 15, and the trend. There's nothing else right now we're going to use to assess a trade, because we're going to put it together one independent variable by independent variable. And that's the only way you can create a trading system. Now, this is a little bit of discretion, but here's where you can take it. You've got these two candles, and they're taking a trade, and it's definitely the counter trend direction because they're taking it above the 50. And we've already defined that above the 50, the bulls are in control. And we're never going to take a short candle above the 50. Boy, the E-mini is going lower. I can tell you that right now. This is really going to be a massacre day. Now, taking the first up candle gives us the opportunity to run over all the traders caught here. That's why it's great to take an up candle off a down candle when everything else aligns. Here's where you take a little bit of risk because the trend is not quite crossed the 15, but this is such a compelling formation. It's where you would consider saying, you know what, I'm going long here. I've caught two groups of retail traders in the wrong direction, and I'm going to take this long candle. And the long candle, it's going to be a very powerful move up. The key is the 15, the 50 is green, the 15 is green. So we know that momentum is to the upside on our trading chart. It does matter. And we get the up candle and up we go. But the trend line has got to be green. Optimally, you want it above the 15, but I'm just showing you trades where you can. Now you also want price to be sort of tight to it. You don't want to, I call this a floating candle. I mean, even when the trend line crosses here, the candle is significantly off support. Now, as long as you understand that if you take the trade long, it's associated with increased risk. But the great trades are like this, where the candle body just hugs the 15. And look at the separation here. It's huge. And that tells you you've got great volatility to trade. And the chance of getting a nice long runner here are really excellent. So this is a real key component to our trading. And if you look at winners that I took, I always took them with the trend above the 15 with some separation. The greater the separation, the better. Now, the biggest mistake I make, and a lot of traders make, is when we start getting price action like this. Let me find it for you. Let me go back further on the E-mini. Let's go back 3 days. You see where the trend is all the way up here and price is all the way down here? You just don't touch any of this. I'm telling you, this is what's going to blow out your account. I'm telling you. All this stuff you just leave alone, because there may be a huge winner in here, but you have to have the fortitude to let a high risk winner go, because you're going to get a lot of potential losers here, and that's our goal: avoid the losers. In avoiding losers, we're always going to miss a winner. I just want to never forget and remember for all time to come. If you trade with sensitivity, and I hate the way this thing, you're looking for true positives. Hold on. And I'll just put another text line in. Over true positives plus false positives. And to sum this all up easily, when you trade with sensitivity, what you're looking to do is capture every winner. I mean, your goal is, no matter how risky, and it has to do with fear of missing out, FOMO, which is also an account killer. If you chase every potential true positive, you're going to pull in a lot of false positives. And those false positives are the losers. And when you start pulling those in, you're never going to make money. We trade our mindset, and this is the way you have to trade. Very few traders do this. You have to trade with specificity. Now you're not going to be successful every day, but if you're successful 8 out of 10 days, you're going to make a lot of money. And we're looking for true negatives. A true negative is a loser. And that's a real trade that doesn't make it. And we put that over true negatives plus false negatives. And what's a false negative? A false negative is a winner. It's a trade that we think is going to be a loser, but it's not. It's not a false negative, it's a winner. But we can't care about these winners. We have to look for the true negatives, not the true positives. Because I'll show you one more thing, which I'm telling you no one ever sees. And I'm just going to abbreviate it. It's sensitivity. And I hate having to make different lines. I don't know how else to do this. But it's sensitivity over specificity. And here's really what matters. Multiplied by prevalence equals your positive predictive value. What is your positive predictive value? That's the number of winners you get. Now, when is the prevalence of a winning trade most likely to occur? It's in a trend. It's all being recorded. So if we don't trade in a trend, when the prevalence of getting a winner is highest, no matter how great we are in our mindset of looking for every thing to set up perfectly, if we don't take a trade in a trend, the positive predictive value or the likelihood of getting a winner is going to fall astronomically. And I can give you a really good example. And the best example I can do is give you one in medicine. And if you do a test, say like for HIV on 100 people, and you do it on two groups of 100 people, and one of them are 100 IV drug abusers, and the other 100 are 100 people and they are clergymen. I don't know how to spell it. Now, if you get a positive test for HIV in an IV drug abuser, what's the likelihood that it's a false positive? Almost nothing. What's the likelihood of a positive test in a clergyman? Well, it's very likely to be a false positive. And that comes right down to prevalence. The prevalence of HIV in IV drug abusers is incredibly high. The prevalence in clergymen is incredibly low. And that's exactly the same thing as it is in the trend. If you take a trade in a choppy market where the likelihood of getting a winner is really low, it's most likely going to be a false positive move or lead to a loser. If you take it when the prevalence of disease or the prevalence of a winner is very high, you're likely to get a winner. So you want to take a trade with specificity, trying to avoid losers in a defined trend. And I'll tell you, if you keep that mindset and remember these numbers, it's going to really redefine the way you look at the market. Because it's really about the math. It's not about the gimmicks. It's about really defining it with applied mathematics. Now, so far, this is all we've used to define the trend. We have the 50, we have the 15, and we have the trend. But we need much more than this to give us a really good way of assessing a trend. Now, the other thing that's really important is to know that any indicator that assesses data from your trading chart, except for these, I mean, you need something to tell you what price is doing on your trading chart. But 99% of all indicators that assess data just from your trading chart are worthless. And this is what 99% of traders are using. Because price, if an indicator is assessing price on your trading chart, how can it have any predictive value as how price is going to move off the right edge of the chart? And everyone's using stochastic and MACDs, trading off the chart. I'm not going to go into this, and I don't want to go into, my Fibonacci rant. But Fibonacci doesn't define areas of support and resistance. It's not possible. I remember Gann theory and Elliott wave were made to define market sentiment in a market in which the power of each bull is equal to the power of each bear. Thank you, Robert. When the power of each bull equals the power of each bear, Elliott wave and Gann theory are going to work. They accurately define market sentiment. But in this market, this is dominated by institutional money. 70% of all of the total volume of every market, and not just Forex futures, but 70% of the volume of each individual stock, we have to assume it's comprised of institutional money. And if you trade price action, Elliott wave, Fibonacci, Gann theory, when institutional money kicks in, they're going to run that over. That's why we trade Unorenco. because candlestick formations, of which 9,000 people are trying to sell you and trying to teach you, is irrelevant when institutional money kicks in. Institutional money creates the multi-time frame trend, and it creates those multi-time frame alignments that we look for to trade on our trading chart. But you cannot use price on the trading chart, or it takes, well, listen, we want everything to be independent variables. And an independent variable is something in which there's no association between the two. And I'll give you another example. Like Fibonacci, though, doesn't provide you with, listen, if we look at Fibonacci, and I'm going to tell you, we looked at it until we're blue in the face. Here's a Fibonacci retracement from here to here. Now, this guy was a 14th century mathematician. Now, why does this line define an area of support or resistance? I mean, it's a hoax. I mean, it's not based on anything that's taken place in the market. Now, Fibonacci has symmetry in nature, but why the heck would there be a significant amount of buyers or sellers at this line? I don't know why. And we've looked at Fibonacci. It has no support or resistance value. I don't care if you look at it on 200 time frames. It isn't going to provide you with any value. And fib traders all go broke. I mean, listen, anything that's been around in the market for the last 40 years is useless. Because for the last 40 years, 95 to 98% of day and swing traders have gone broke. So if you use anything that's been around since the dinosaur era, it's not going to make you any money. And to think that somehow this is going to magically define some area of support and resistance is nuts. And I hate to say that, because I know a lot of people like it, but trust me, it's not any good. I don't know, it has a lot of appeal. And when some wiseacre rolls out a new piece of software, and they're just marketers and not traders, they always throw in Fibonacci. Fibonacci, but I'm telling you, stay from it like the plague, because retrospectively you can always create a scenario where it looks like it holds or has value. But moving off the right edge of the chart, God forbid you should try to use this as a tool to predict price movement. So let me take off all the drawing objects. Now, this is not enough, even though it really helps define our goals and define our trading mantra and our I call it our theology. I mean, if you're a religious person, you adhere to the theology of your religion. In trading, you have to adhere to your trading theology, and if you don't, you're going to bust out. And again, one of the problems I have is that sometimes I don't obey rules, and you have to. So let's add an assessment and start making, now as we add each individual parameter, we start trading with more and more specificity. And that's tougher to get a winner. But when we do get an alignment, that winner is more and more likely to work. And let's put in the most important independent assessment we have. And that is this is background bias. Now, what is background bias? It's simple. Now, first of all, let me just tell you the Keltner channels. I just put in. One of the traders in the room gave me the idea. And I get great ideas from traders in the room. I mean, they've helped me improve the system a lot. Some of the suggestions I get are awesome. And one of the traders, excuse me if you're in the room, said, I was always scaling, because remember, if you don't have the Keltner channel and price is all the way at the bottom of your chart, you have to squeeze it to make sure that hidden below isn't a pivot or a zone. But with the Keltner channel, and I make it white, you can't make it transparent or it doesn't work. I remove the center line. It's just there to center price. That's all. So it's nothing. Don't even look at it. In fact, when you look at a Keltner channel, you see how valueless it is. Just like Bollinger Bands are valueless. Now, I'll tell you this, and I'm going to get to this in a second. Bollinger Bands have their basis in sound mathematics. The problem is they just don't have the power to make you money. But let's take a look at background bias. Now, before I do that, I just want to say one thing, which is really important, and this is really an important principle. Oscillators and MACD divergence and all that stuff do not define a bottom or a top. It is now, in this market, mathematically impossible to call a top, and it's mathematically impossible to call a bottom, although there's tons of software out there that tell you how to trade tops and bottoms. A top is created when institutional money pulls away from a long move. And the bottom is defined when institutional money pulls away from a short move. And you can't have a formula. There's no mathematical formula to define that, because we don't control it. And it's not controlled by any math. Here's the only thing that's controlled by math. And that is that there's always a desire for price to regress to mean. So as the space between the 15 and the 50 widen, there's the force of price pushing back to the mean gets stronger and stronger. So that's why we have to be careful in chasing a second entry, because listen, institutional money can press it down lower and lower, but it may not happen until you get that retracement, retail trade retracement, and then it will move lower. So be careful when you start trading far off the 50. The best trades come tight to the 50, right off a mean price. And that's really important, because as you move lower, now I'm going to show you how I assess overbought, oversold, and it's not off my trading chart. But I'm not going to bring that into play until later on. Let's just first get all the indicators on our chart set up, and then I'm going to show you a really nice way of really getting your trades even better. Now, the pink background, I've gone through this before, but I'm going to go through this again for all the new traders in the room. We have 3 down colors, 3 up colors. And if I don't even have to do this, I can just show them to you. If you open up the indicator and go to the bias, you can see there's dark green and there's dark pink. Those are the 2 strongest multi-time frame alignments to the downside. Then you have cyan and bisque. Those are the second strongest. And then you have the weakest, which is powder blue and misty rose. And here's the strongest. Here's the weakest, and biscuit, and here's the intermediate. Now, they're all multi-time frame alignments to the downside, but they have differing power. Here's your up. That's your intermediate. Here's your weakest. And dark green is your strongest. Now I'll show you what they are. Now they're really, honestly, kind of complex, but I'll try to make it, I'm going to do it on paint because it's a lot easier than doing it on the trading chart. So remember, this assessment is not looking at your trading chart. And 99%, I'll go through all the questions in a second. No, David, we're going to have that alert when all of this aligns. Believe me, I'm really aware of how important an alert like that is, and that's why we're making it. So we tried to make it once before, but it was sort of a half-assed attempt at doing it. Now we're going to make it perfect. Now, your perfect dark green background is not looking at price on your trading chart. And that's what 99% of all that background color is on other software. If you get a move up, you get a MACD crossover and the background goes green. So big deal. You already know that. And who cares? The higher time frames lead price. So here's your 50, and here is your trend line. When the trend line crosses the 50 on the higher time frames, and I'll show you what they are, and price is here, that's your dark green. When you have that multi-time frame alignment like this, and you take a long trade on your trading chart, you're going to have that dark green color. This is when the prevalence of getting a winning trade is the greatest. This is where you desperately look for a long entry. Tight to the 50, tight to the trend line, a pullback, and a continuation trade. Really, this is a nice trade. Now, here is your second strongest color. Now, there are really variations in between, and I could do a whole hour on this indicator, but I'm just going to give you the basic principle. Here, the 50 is up, but the trend line is also up, but it hasn't crossed the 50 yet. Here is when the background color on a long trade is cyan. And you can see that that's a lot riskier. Because you really want the trend line to cross that 50, like here. Now, in order to get background color, price must be above the 50 on the higher time frames. Now, the weakest is when the trend line comes up, crosses the 50, and then flattens. And that's when the background color goes to light blue. Oops, let me change the color here so you can see it. It goes to light blue. Your price is still sitting up here, and there's no way you can go short. But a long trade here is riskier, although you can take it. Listen, the goal of the platform is to define risk. And this is a very accurate assessment of risk. Lowest risk, the trend line below the 50, cyan, riskier. Trend lines cross the 50, but flattened. We've lost upside momentum on the higher time frames, increased risk. So it's all about defining risk. Those are your three up colors: dark pink, dark green, cyan, and light blue. And it's just the opposite. I'm just going to put up new. Oops. I'm not going to save it. For the short trade, dark pink, 50s down, trend lines crossed. Price is here. Let's look for a pullback and an entry as close to the 50 as we can get. This is your prime time to trade. And this is dark pink. I'll make the font bigger. Now that's the same thing. Now we have the 50 down, but our trend line is not crossed. And this color is bisque. Riskier. And then we have the riskiest, where the trend line is down. The trend line, not the 15, the trend line has crossed, but it's gone yellow. And this is light pink. And I'm going to make it, I'm just going to make this dark. So we have our three colors defined. Best time to trade, increased risk, much more risk. No background color. Personally, you're not going to trade, but there is a setup called the transition zone trade you take with no background, and that's going to be the last thing I'm going to go over because they're the riskiest trades and they're the toughest to see. And until you master these, I wouldn't even consider, don't even look right away at getting a transition zone. And let me just say one thing. Everyone's always interested in looking at 44 markets. I mean, it's just, and this is just my personal opinion. Pick a market that you like and master. If you're just starting to trade or you've been trading and you just haven't been profitable, just find one market and master it. And then you will be able to master a whole bunch of markets. Don't try to trade 5 markets. Just stay, because I'm telling you, whatever market you pick, today it didn't even matter. You made money on the NQ, E-mini, gold, or crude. But it doesn't matter if on one particular day, the market you've chosen simply doesn't give you a setup, you don't get any trades. The next day, it'll give you 3 great winners. Just master one market and focus on it because you start getting a great feel for it. And that's screen time. And that's, you just start to get a great feel for how the market moves. And that's just, my personal opinion. And you can see when you have dark pink and you have a setup, the likelihood of it working is very, very high. Right here. If the 2 higher time frames are heading down, what's the likelihood that the price on your trading chart is going to head up? Now here it does. Nothing's 100%, but you can see all it really does is just roll. It goes up. It never really achieves a long position and then just rolls to the downside. We have a much higher burden because we only have a 1 candle reversal and out. So we have no trade here. But here, remember that short trade off the long candle? Now these traders are nuts to go long. Who would take a long trade here? You're below a falling 50. You're below a falling 15. You have a multi-time frame alignment in the E-mini to the downside. The trend line is essentially red. Now, sometimes it doesn't give you a green. It'll give you a yellow. That's just the way this line works. Who would take this trade long? It's not institutions, it's the small retail traders like you and I but these are the retail traders who don't have a clue what they're doing. They're trading Fibonacci, they're trading MACD divergence, they're trading oscillator divergence, they're trading all this stuff, and they're going to go bankrupt fast. That's why this short trade is such a plum. Pink background. You're really fairly tight to the 50. You don't want to be far off a mean, and there's your trade. Now, if we go through the chart, you see, this is where you get killed. Don't take these trades because the trend line is up here. And although this was a winner, we have to sacrifice winners in order to make sure our trades work. Now, this is BISC. We know it's riskier, and we're going to get a first target off of it. This is 1, 3, 5, and it's just going to go 6. It may fill some of us, it may not fill others, but it will definitely bring your stop to break even. But we're not looking at entries here. We're just, you see, look, this is where you're going to go short. When you have no background, you're just not trading. Green, the only way you can go is long. You just don't have a trade here. Nothing here. So all we're doing is defining risk. And look at this long trade off the short candle at 9:55. I don't know what day this is. Now, after you're in the trade, the trend line sags, but that doesn't take you out. All you do is look at the trade at the time of the entry. That's a gorgeous entry. And you're trading in the multi-time frame direction of the trend above the 50, 15's heading up, 50's heading up, 15's heading up, trend is heading up. It does sag and then come back up. That doesn't matter. It's not a signal to exit the trade. We're heading up. So I hope I've explained. I just want you to know what this is much riskier. Remember the trend line on the higher time frames are flat. So although we can only trade long, we don't have a lot of upside momentum here on light blue. Here's where, I mean, this trade, man, if you could trade 25 contracts, this is where you're going to trade it. You're so tight to the 50 and you're trading off of a down candle, off of cuckoos who don't have a clue what they're doing, and this is just a killer trade. Now, I mean, it's a hyperbole to say you're going to trade 25 contracts because a person can always fail. But this is about as low as risk as trade as you're going to see. You get the separation between the 15 and the trend. You have a multi-time frame alignment to the upside. 15's cross the 50, or the trends cross the 50. They're both green and heading up. This is your plum area to trade long. And this is where you're looking for your best trades. And the market's unlikely to go against you. And there's your trade. And same thing is true, for short. Dark pink, BISC, that trend line hasn't crossed the 50 yet, but they're both red. It's a riskier, but it's still a decent trade. We just don't have a setup because of the trend line. So I think you now understand how important background bias is. Now, there's a mathematical equation that actually tells you that, and this is one of the things that create headwind in trading that we can never overcome. That in every given trade, the power of each independent variable changes. But in general, this is the most powerful independent variable we have. I don't care if We have the quants, the Laguerres, and everything. We're not trading in a multi-time frame alignment in the direction we want to go. The risk is significantly higher. And this is really what you have to watch. Cyan is okay. We know that the trend line's heading up. Here you see it crosses and it matures to green. That light pink, you have to be very careful. I mean, the light pink and the sky blue. They're tradable though, but they're riskier. No background, don't trade, because the higher time frames are not in alignment. And you can see, I mean, if anything defines better what happens without background, it's right here. Remember we talked about prevalence? What's the prevalence of getting a winner in here? None. I mean, it's like slim and none. I mean, try to get 6 ticks here. You're never going to get it. Try to get 3 ticks here. This is where you stand down and leave the trade alone. Thanks, guys. We're still going. So it's all going to be recorded. So let's take a look at our next really important indicator. We're going to look at the quants. Now you see we have a quant for each market. So we've done a lot of work. And this is a really important assessment. Now we should get 2 lines. And let me find out. Hold on a minute. Let me open the indicator. And let me just find out why we don't have 2 lines here. Oh, here it is. No, they're not here, Rory. Oh, yeah. Here we go. There they are. I'm going to make them really big. I want to make them obnoxiously big. But here they are. Now, what these do is they look, now remember, if you look at price on your trading chart, you have no predictive value. None. This multi-time frame assessment ignores price on your trading chart. These quant lines ignore price on the E-mini. What they're doing is they're looking at a multi-time frame alignment and trend of the correlative markets of the E-mini. And they're looking at the Dow, the Russell, I spelled that right. I may not have, but I think you know, as long as you know, and the NASDAQ. Now, this is the faster assessment. And this is the slower assessment. On a transition zone, which I'm going to show you, you only need the faster. On a trend trade, you need them both. And when you have the Dow, NASDAQ, and Russell in your direction on a multi-time frame basis, and you have, in this case, the BISC or the pink background, the likelihood of taking a loser is starting to fall. And you'll notice that you lose the quants when the market starts to chop, because the Dow, Russell, and NASDAQ are starting to chop. Now, the correlation between the NASDAQ and the E-mini is very tight. And that's why we call these quant lines, because the correlation coefficient of the NASDAQ is about 0.9. So 90% of the time, the direction of the E-mini and the NASDAQ are the same. So the NASDAQ is quantitatively weighted heavy. The Dow just barely breaks 0.7. Now, if it doesn't make 0.7, it's got to be thrown out of the assessment. So it's quantitatively weighted less. And the Russell's in between. But when you get these three lines aligned, and remember, they're not looking at price on your trading chart. So they don't go green because price is rising. Price is rising because they're green. So it turns around what happens on most indicators on 99% of the software. This is telling you that price is going to get pushed up because the Dow, Russell, and NASDAQ are moving up. Here, you just don't get a great, well, you do. And when you have all this junk, look how this line reacts. There's no red here anywhere. And then the multi-time frame alignment is created by the alignment also of the Dow, NASDAQ, and Russell. You would, I mean, you would definitely see why there's an association between the two. Now here, you just don't have anything. Here's where you get your really great assessment. And you need red. Look at that. Right here is where you get it. If you get any pullback inside this candle here, you're going to take it short. And you can see how we're making it harder and harder to get a winner, but the likelihood of getting a winner is getting higher and higher and higher. And we're staying with our goal of not looking to get every winner, but attempting to avoid every loser. And if you stay with the rules and adhere to them religiously and don't screw up, the software is going to work for you. Look at the space. It's opened between the 15 exponential and the trend. The candle body is tight to the trend. And there's your bona fide, really nice trade right there. And I could go on and on with it. Can't trade here. You only have one line. We know BISC is a riskier setup. We're not, and this is what saves us from taking any losers here. And here we go. This is a very risky background bias, background color. Now the dual quants, this is a discretionary trade. I might have elected to stand down on it. We don't know. But you can see how when the markets go green, when the correlative markets go green, and the space opens and the candle's right off, you have to have a pullback wick. You could have taken this long, but it's a riskier trade. And here is where you look for your perfect. If you get a pullback here, you're in. In fact, here is where you might have taken a loser. Like I said, it doesn't work 100% of the time, and I'm not going to high losers. There's where you got your continuation short that doesn't make the 6 on dual quants, background bias, the whole schlemiel. Now, there's a couple things I want to mention on this trade, and that is, and this is a lot to take in. and it's hard to assess, but you can see that the area of low volatility was small, and optimally you want a long area of low volatility than high volatility. Low volatility, high volatility. See, this is riskier. Here's your low volatility. There's your high volatility. So there's a lot of things going on in this trade. And like I said, making an assessment of all these independent variables can sometimes be very hard. Only this would be a trade I would have taken, because even though I had a very small area of low volatility, I was trading off of these 2 up candles, and I would have figured running them over would have been enough to have pushed me down. That's 1, 3, 4. I would have missed it by 2 ticks. So I would have taken that trade, even though I'm coming off an area, just a short area of low volatility. I'd like a long area of low volatility, and then the move short. So I'm just trying to, and look at that trade. Boom. Everything comports with what we want. So now we're going to add more. We're going to add the Laguerre. Well, let's add the dots, because the dots go with background bias. Now, these may be the wrong dots. Let me take these off. Yeah, see, these are gold dots. Remember, these are looking at the multi-time frame alignment, and this is not an easy platform. We need dots for each of our markets. So we need our E-mini dots. Here's our E-mini fast dots and our E-mini slow dots. And there we are. Now, these have not been, they're too tight to the candles, but that doesn't matter. All the dots are doing is this is on a very slow time frame. 2 higher time frames are relatively slow. The dots are on a slightly faster time frame, and the X's are on a faster time frame still. But if you look at the indicator and you open it and you look at the dots, you see the same 3 colors. Now, we can't make them identical to background, because as I said, they will vanish into the background bias. But the darkest dots tell you that on the shorter, higher time, multi-time frame alignment, we have it. Now you see, as we move up, we start losing the dots. And on the move down, we not only want the background, this is also doing the same multi-time frame assessment, this faster still. Same principle though. Same trend crossing. And you see how the color gets darker and darker as the trade matures. What I found, as long as you have dual dots on a trade and you have the dark pink, you're good. And here's your great trade. So the dots are essentially doing that same multi-time frame assessment of trend as the background, just on faster and faster speeds. And they do have that validity. Now look at that up candle on those 2 down dots. I mean, that's an insane trade. That's why you're going to take that first down candle and blow those traders away. And this is why you can't counter trend trade. The multi-time frame alignment and trend is not swung your way yet, and you just can't take it. The only thing that you can take here is a short trade, and here's where you start looking for your long trade. Dual dots, dual quants, the trend crossing the 15. And those are your really pretty trades. Now, you can see how much work and thought's gone into the platform. I mean, and that's why it's so hard to move to other platforms, because everything does a multi-time frame assessment, and every dot system is different. Every system has its own set of quants. So it's very difficult to move this, like say to MetaTrader and Sierra. Now we had it on Sierra, but we just couldn't keep up. So now let's look at the Laguerres. Now, oscillators are really important. Now here's the modified Laguerre. Now here's the signal A, and here's the signal B. I hope I have them right. I'll know in a minute here. Let me see what this is. This is the signal B. And where's my signal A? Hold on a minute here. Let me see if I moved it down. All right, well, let me move the signal B from 4 to 1, 2 to 3. Let me move the Laguerre to 4. This is going to be the biggest jump we've got, and then it'll probably appear. Move that to 4, or a new panel. And there's our quants. Here's our Laguerre signal. Now what I'm missing is my A signal. Let me find it. My Laguerre signal A. It's in 5. I think let me see what panel it's in. Okay, it's the same as the input series. So it should be in panel 1. It should be in panel 2. The Laguerre signal B should be in panel 3. No, I'm sorry. The Laguerre signal A should be in panel 3. Laguerre signal B should be in panel 4. And we're going to have to stick it like that for a minute. And we'll move the Laguerre into the new panel. I'm going to have it. New panel. Here we got them. Now I'm not getting an A signal just because it's probably not set. Let me just set it, and we'll be good to go. I'm rebuilding the workspace and the signal A. Okay. This is B, and here's A. I don't know what happened to I don't know what happened to it. Hold on a minute. I'm sorry. It's the wrong indicator. It's not this one. I'm sorry. One of these we don't use. It's the MTF signal B. This signal B we remove. Now the MTF is got to replace. It's got to go into panel 1, into panel 3. And on the E-mini, we're going to set it at range 8. Let's see if I got it right. All right, it's just the panels now that I've got to get right, and then we're good to go. So the quants go in panel 2, and I'm sorry about this, but the quants go in panel 2. The Laguerre signal A, or the MTF, goes in panel 3, which it does. The Laguerre signal goes in panel 4, and now we got it. And the Laguerre goes in panel 5. We don't have it yet. Let me just do this. And let me move that to panel 5. So you don't try to rebuild your workspace. Now, hopefully we got it here. Yay, I think we do. If not, I'm going to have to call Sergio to find out why we're not working here. Let me just make that thicker, and we've got the multi-time frame here on an 8 range input, which is correct. And you know what? All right, this is good enough. I'm just going to close this up. It's actually easier to do than this. And what I could do is just reload the template and start deleting indicators. But I'll just leave it like this. Now, the Laguerre on our trading chart is important. Now, the Laguerre is different than all other oscillators. There's a whole bunch of oscillators out there. There's the RSI, there's stochastic, there's the Arun, there's the Williams R. There's a whole bunch of different oscillators. And I have a slide. Yeah, this is definitely wrong. I have the wrong. Not the MTF Laguerre isn't wrong. You know what I'm going to do? I'm just going to make this easy. What I'm going to do is I'm going to insert a template and just delete the stuff I don't need. And because I want you to see it all right, all correct. That's what I should have done in the first place, because we're getting to the point where we've got most of the stuff in here. Let's just delete what we don't need, or we don't want to look at right now. We don't want to look at the pivots or the levels. The bar closes don't matter. The bias we want to look at. Don't want to look at the continuations. Don't want to look at order flow. We don't want to look at this. We want to look at the modified Laguerre. We need the trend. We don't want to look at consolidation. We don't want to look at the volume zones. The hybrid candles we want. We want the quants fast and slow, and we'll remove that for now. So now we got our template. And it's perfect, which is what I should have done in the first place. So the oscillators, yeah, I know I'm screwing something up there. So the oscillator, the Laguerre oscillator is different than all the other oscillators. Now, an oscillator is simply looking, I could put up the formula, but the oscillator is simply looking, first of all, it's a second order derivation. It's not looking at price, speed, it's looking at price acceleration. And what is price acceleration? Acceleration in price to the downside is if you have two candles or we can just use one, and we have a line. Now, obviously, here's the low of the candle, and here's going to be the close of the candle. Now, price accelerates to the downside as the close continues to approach the low. As the close inches closer and closer to the low, price is accelerating to the downside. Now, George Lean, who developed this indicator in 1963, came to the conclusion, and he was a brilliant mathematician, that, first of all, this is a second order derivation. Because it's a measure of acceleration in speed, not speed. So if you have a car that's moving around a racetrack at 150 miles an hour, its momentum is unchanging. If it accelerates, momentum starts to move to the upside. If it decelerates, momentum moves to the downside. And he felt that because it was a second order derivation, even though it was on your trading chart, it would lead price. And back in 1963, when he developed it for one purpose only, and that was to trade divergence. Because in 1963, the amount of institutional money present in the market was probably zero or negligible. And the market consisted solely of us as small retail traders. And I would imagine that divergence would have been a very good signal. Now, the guy died a pauper, for what it's worth, but he wasn't really a trader. He was a mathematician. And all mathematicians die paupers. So anyway, you're looking at price acceleration, but all the other oscillators are chiefly looking for divergence. And if I put up a chart and put up the RSI, the stochastic, the Williams R, the Arun, you would see how radically different they move from the Laguerre. The Laguerre was created not to look for divergence, but to actually track price acceleration, deceleration, and that was its number one and only purpose. So that's why we use a multi-time frame assessment of the Laguerre. Now, this is the multi-time frame assessment of the Laguerre. This line. Now, when the Laguerre is below the 80 line, or below the 20 line, excuse me, or locked short, only big money has the power to do that. And when it's done on a multi-time frame basis, you know you're in good shape for a short if everything else aligns. Here, it's simply sloping to the upside, is light green. And then when it locks above the 80 line, it goes to dark green. Here it's sloping down. Here it locks short. But here's the only case where we just cannot ignore momentum on our trading chart. We have to respect it. It doesn't have predictive value as to how price is going to move out into the future, but we can't trade against it when we take a trade. Now, it's acceptable. This line, you'll notice, is telling you exactly what it's doing. This line right here. Oops. Oh my God. I think I screwed it up by dragging that down. Hold on a minute. I did. Hold on. I just unscrewed it up. Now, if you look at this line, you see how the Laguerre is sloping to the downside? Right here and here. And you see here it crosses the 20 line, and this goes red. Here it crosses the 20 line, and it's heading up, and it's light green. Here it crosses the 80 line, and it goes dark green, all this is doing is telling you what the Laguerre on your trading chart is doing. Now, if you want to simplify, you can remove it and squeeze it and not look at it. But if you look at it, it gives you the ability to sort of anticipate and make an assessment of how momentum is moving. And now that we don't have that fifth line, which was our really our major attempt to correlate the cash market movement with futures market, but it just doesn't work. You can actually look at this and you can see how it's moving, but it's going to be reflected in these colors. And we want momentum in our direction on a multi-time frame basis, and we don't want to be trading against momentum on our trading chart. So we want, doesn't matter if it's orange, momentum is heading down. We want dual reds or orange and red, and we want dual quants. Optimally, we want pink. We want that 15, the trend line, to be separated from the 15. We want dual dots, which is another multi-time frame assessment and trend, just on a faster and faster time frame. And we want all of this to be aligned. And you can see it's getting tougher and tougher to take a trade. But when we take a trade, it's more likely to be a winner. And you see right here, all the way down. And all of this stuff here, until we get here, we ignore. This trade is too mature to take a trade. It started here. And we're not going to get into the trade on a pullback all the way up here. We really want to try to get in at almost its inception. Here, this is an early entry. Trade started really right here, and we're in. This is a terrific entry off an up candle. And we've got a multi-time frame alignment of Laguerre momentum, the quants, the background bias, dual dots. We've got everything that we possibly can swing in our favor, swinging in our favor. And that's what we're trying to do. Now, I just want to do one thing really quickly on those fast dots. I just want to bring them in tighter, and I really shouldn't do that now. But the offset is 13, and I'm going to move it to 9. You see, now they're tighter. I'm just going to save that as a template. I'm going to save that as my new E-mini template. That's all. And it shows you how you save a template. Just click and hit. So you can see how we're starting to swing everything in our favor in these trades. We're leveraging everything that we can. Now we're going to add what's really important, and those are market created areas of support and resistance, the pivots and the volume zones, which are the VZ zones. I can find them. Here they are. Now the pivots, we set the sensitivity to 150. If we drop this number, we're going to get too many pivots of minor significance. If we raise it, we're going to lose pivots of significance. This is just a trade-off between sensitivity and specificity, and it's our best assessment as the best number that you can get. The volume zones are a multi-time frame assessment, which on the E-mini is always an 8 range, and we just have them too thick. That's all. The VZs, see the width is 10, just move it to 1. Now what we have is every major turn here creates an area of support. And you see price comes down. We don't have a trade, but if we did, it bounces. Here, it actually does break it, but we're never going to trade into an unbroken pivot. Now, our pivot indicator is different than almost every other pivot indicator for two reasons. First, a pivot is created by a candle body, not by a wick. Most pivot indicators would put the pivot here, and that is wrong. Japanese candlestick dogma tells us that it's the candle body. So this is where the pivot has to go, and this makes a big difference. Only this coding is easy. This coding is hard. The other important factor is you'll notice that when you get a little piece of candle body that closes below the pivot is not broken. 2/3 of the candle body has to close below the pivot to break it. That's where these buyers are taken out. They're going to help push the move to the downside. Now, it doesn't always work, obviously, but the pivot indicator is coded to break only on a 2/3 candle body close. So that's what I'm trying to assess when I take a trade into a pivot. Will that candle body on close 2/3 above or below the pivot? Every other pivot I've ever seen will break on a wick or any price that crosses it. That is not the way the Japanese candlestick, the rice traders wanted it. And I have all of Steve Nissen's books, and they're wonderful. It's a 2/3 candle body move down. Now, so those are the pivots. And with the sensitivity of 150, you have to respect every pivot on the chart. Now, you can see price move through this like butter. But since we don't know that this is going to happen, we just cannot take these trades. And if we do, you see how often prices bounce off of them. In balance, we're going to get creamed if we trade off, if we make an assumption. Now, I have tried my best to try to figure out something that will tell us whether a pivot will break or hold, and there just isn't anything. Whatever determines it is something I've not yet been able to elucidate. So since I don't know, we have to avoid them. Now, these are volume zones looking for areas of buy, sell, and balance. It's a multi-time frame assessment. And this is where we know a lot of buyers are sitting. It's another very strong area of support. Price just cut right through it. But I'll tell you, price bounces off of these. Here's the move down and the bounce, the move down and the bounce, the move down. It just made it, but there's one right here and the bounce. Cannot trade into these. And we got a million of them here. We'll make sure I put this number in right, because we've got a lot of zones here, but I'm 99% sure I did it right. Yep, it's right. This is just the way it is right now. We've got a lot of areas of support and resistance. And when I talk about taking a trade that's free and clear, it's where like you can't even see it. Like right here, beautiful. Nothing below us. Nothing below us. Great trades. Stay away from these areas of congestion. All they're going to do is create havoc. And at the end of the day, they're going to cost you way more money than you're going to make gaming what I call a trade in anticipation that you can squeeze through, because these are areas and not discrete lines. Just wait until you break out and you start getting areas like this. and you're going to start racking in winners. And just wait. There's your pivot break and your winner. Winner, winner. Stay away from those areas of incredible congestion and just forget about them. Now, let me put in consolidation. Now, I'm sure it'll be set wrong. I'm going to stick it in. Now, it is wrong. I happen to know, I believe, what the setting is. It's I think this is an 8. It's always 2, 4, 1. The side range movement is what changes from market to market. Now maybe a 9, 8 may be too tight. Let me just look for a minute, because there's really no areas here where I see much consolidation. Yeah, let me just go one more. Let me go one more tick on that. And I want to explain to you how we define consolidation. This is correct. We just have to wait for a zone to set up here. Now we see it all the time, and now when I look for it, can't find it. Let me refresh the chart. I must have some number in there that's wrong, because we should be seeing some consolidation here. Some consolidative pattern. Let me look at the indicator again. We've got line width, number of bars is 4, plot offset is 1, range of side movement. You know what? Let me try 7. Let me ask Sergio. Hang on one second. I'm sorry. I don't have all these settings memorized. That's why I use a template. I mean, look at this move down on this break of support, on this pullback here. Now, if we got a pullback right here, we've got this move down. This is why you just have to have patience. You know, it's patience and it's discipline. If you just wait, you're going to get these areas that break out and give you absolutely superlative trades. Then this long area of low volatility, you know, is going to be followed by an area of high volatility. Then long area of low volatility, and you get a nice area of high volatility. Now you can't take this trade because this is just a little bit too far to trade, and it's 7 o'clock in the morning, but you know what you're looking for. Hold on, let me get Sergio. Hey, Sergio, I need you here for 1 second. If you're on the phone, just put him on hold. I know you heard that. I just left the mic open. That's our intercom system here. We scream. Hang on 1 second. We actually have an intercom system. We don't use it. You know, Sergio may be at lunch, because what I'm going to have to do is go back in. You know what? Here's what I'm going to do. Because I just want to give you the principle of consolidation, because it's extremely important. And I don't know why the indicator is not working. And because it should. on that setting. Range of side movement. See, as I lower that number, making it easier and easier for consolidation to appear, and it is not appearing. So you know what I'm going to do? I'm going to take the indicator out, and I'm just going to bring down the default indicator because it had areas of consolidation in it. And it's set at 15, which is way too big. I'm just going to set it at 10. All right, I give up. I'll just go to 15. At least we know we'll get it. This is building a template. Here we go. Now, here's the importance of consolidation, and I want to define it for you. Now there are too many areas here. I don't have the number exactly right, but let's just take one area of consolidation. Let me find a discrete area where I don't have multiple lines. Here's one right here. Now in consolidation, okay, consolidation is 281 thank you, Lee, 281.13. Lee's the man. I should have looked over there. Is 2.8. I don't think it's 8 bars, Lee. I'm going to go to 13, but I'm just going to keep it at 4 just so we get more consolidation. You're probably right. Let me go to 8 because Lee is wrong once a century. Yep, he's right. He is right on. Okay, now we have the correct consolidation. Let's find a nice area. There's a lot of consolidative patterns just don't have any meaning or any relevance to trading. Now, here's an area of consolidation. And here's what's taking place in consolidation. In consolidation, what we assume in this channel is that the power of the bulls and the power of the bears is equal. And we've caught a lot of traders in both directions. You can't trade this. And I lost a couple of trades yesterday trying to trade in consolidation. You have to respect consolidation. Now, Ninja Code will not let us bring these lines over, but you can't take this trade until you get a 2/3 candle close above this consolidative pattern. You need to break out of consolidation in order to take a trade. So when you're taking a trade, like just look at this trade here. Now, obviously the pivots constrain the trade, but look at this long area. Look how far that is, where the power of the bulls and the power of the bears is equal. And what you've got is a ton of traders caught both long and short. So when you get the breakout of consolidation, which is right here, it's going to power down. Now, you can't take it into an area of support, but that's what you look for in consolidation. One, don't take a trade in a channel. Trade the break. And you've got traders caught in both directions. And whoever wins is going to win big. And the longer the consolidative pattern is, the stronger it's going to come powering out. So that's why we have that consolidation. It's very hard to see without an indicator. And the indicator makes it really obvious. Don't take a trade inside this bracket. And don't trade inside this bracket. Because you're going to get hurt. And I got hurt yesterday. It's a much riskier trade. And again, our goal is to avoid risk. Now let me see what I haven't added here. I add the dots, bias. Now the continuation signal is really an imperfect signal that we're going to replace with the revolution signal. I'll show it to you, but it doesn't have that much. It does a multi-time frame assessment like the revolution signal does, and it really is a pretty good signal, but you can't take it. It's right here. And you see it, look at the trade that it gives you right here. I mean, that's a killer trade. Now we have it formatted formally as a bar, not as a dot. But it usually fires when you got a great trade. Pay attention to it right now, although we're going to be replacing it shortly. Right here. And there's another one. Look at the trade. Now this is looking at price action and market structure on a multi-time frame basis. And if I can click it and open it, I can't. I'll show it to you. It's doing a multi-time frame assessment. You know what? The multi-time frame is buried inside the logic of the indicator. We don't have it out anymore. But trust me, it's doing a multi-time frame. It is not looking at just price on your trading chart. Otherwise, I would tell you. Another signal, terrific signal. This is a good signal, only it just fails. So pay attention to it, but don't blindly take it. And we're going to be replacing it with a better signal. Let's see what else we got. The hybrid candles are simply what give us the wicks. Now the levels indicator is really simple. It gives us yesterday's close and today's open. Now I'll just show you. We looked at, these are the things that we threw away. We looked at a modified Ishimoku cloud. It does not work. It is complete garbage. I just want to, we have a bucket full of indicators that we looked at to try to make our system better, and that just didn't work. Let me keep going. Oh, order flow. Now, order flow, which I want to put in the new panel, is going at the bottom. And we cover it up. Because order flow is what gives us our candle halo. And it's the end of all the indicators. It has, if it didn't have predictive value, we would not use it. But it is the weakest of all the indicators. And even though we assess order flow on a multi-time, like that's a great trade. Look at the candle halos. They're all magenta. Now, if you look at order flow, you can change the halo, color, and the thickness, you just have to go up here. And this is, the candle body outline, I have is 3 point, the candle wick is 3 point. You can change the thickness of the wick and the candle body. And it's the twitchiest indicator. And although we've done our best to eliminate the outliers, we have not done it completely. And you see how this candle body calls the reversal? That's order flow is turned, it's up, and we get an up candle. It has value, but you can see how in this down move, it changes color. Now this isn't the right color because I have recalibrated the chart multiple times. And that's because even on a multi-time frame basis, it does not assess the aggressiveness of the buyers and sellers. And let's say this was blue. And blue is telling us that in this candle, the market deltas are telling us that on the trading dome, there's an overabundance of buyers on a multi-time frame basis. Yet it continues to fall. And the reason it does is because the sellers are more aggressive. It's an indicator to take note of, but if you have dual Laguerres, dual quants, background bias, the trend, crossing, space, everything, I would be careful on the entry if you don't have order flow, but I might take the trade anyway. Every single independent variable has power. This one has the least power, but it's still important that you note it and understand how it works. Now, I think that's the entire workspace broken down. Now, I'm going to show you something, and I don't want to confuse you. And this is a lot of information, but I want to give you every chance. Let me just make sure that I've got everything here. And then we're going to look at some stocks. And then I'm going to run out of voice. Hold on a minute. I showed you the volume hammer, and you can use it. You want to put that line across your threshold volume. We did the Laguerres, we did the quants, we did the trends. So we're good. That's basically, see there the QQQ dots? We've covered as much as, we really got everything here. Now, let me just put up the analytics. Now, the analytics right now show you the total volume crossed. Now, the MA diff, we still have to work on. That's the space between the 50 and the 15 that defines overbought, oversold. And this slope here has turned out to be irrelevant. We've left it up, but we never look at it. It was my initial assumption that the slope of the line would have predictive power, and I'm not going to go into that assumption. But the bottom line is that right now, these two slope lines don't matter. Now, here's the thing that I want to share with you, and that is this. I'm going to close this down a little bit. I'm going to move it over. Now, on the E-mini, we look at two higher time frames, the 5 range and the 8 range. Now, our multi-time frame analysis is not on Unirenco. It's on range. Now, that's the 8 range chart. And we'll give you the templates for this. And it's a very simple chart. It's got the pivots, the Laguerre, the trend, and an SMA 50, not an exponential. So if I'm on the right edge of the chart right now, what am I anticipating? I'm anticipating a short trade only, because the highest time frame I'm trading has the trend below the 50. So it just gives me, it's like a dashboard that I use. And if you look at the highest time frame, it'll just tell you the direction that you want to trade. And it's very, very helpful to anticipate that direction. On the NASDAQ, it's a 21 range. It's a 13 and 21. And if we go to the NQ, you'll see that we're just looking for a short trade because we've got that trend below the SMA 50. A long trade is risky. Now let me show you what a transition zone is. I know this is a lot, but here's a transition zone trade. I'll show you the one I took on the E-mini, and I'll show you why I took it. Now, I don't know why I have all this junk up here. Now, to take a transition zone trade, you must have that higher time frame up. And and then I'll answer any questions you have. It's a lot of info. But it's the nuts and bolts of the system, and you'll slowly pick it up. Trust me. But now you know the meaning of everything. Now, here's the trade. Now, this line we make transparent. And let me just make it transparent. You know what? Now, what I'm going to do now is I'm going to insert the template. So we have everything perfect. Just going to insert my E-mini template, my ES2U. And that's a perfect template. Let's go back to the trade. Now we have a low of day and high of day indicator. That's the low of day is maroon. Trading into it is risky. I lost trades yesterday trading into low of day. And here are the two colors. We took it right off a Ninja. I don't care about the open. The current high is green. The current low is maroon, the high of day. And I'll show you the trade that I took. In fact, this may be even a better transition zone. Let me take a look at this. And in order to do that, I have to kind of sort of globally track, but I can do it here. That took place at 11:19. And let me just go quickly to 11:19. And I'll show you the trade. Here it is. Now, if you look at your higher time frame, this is 11:18 to 11:20. And you look at this space. There's nothing here. There's no upside resistance. And on our trading chart, when we cross the 50 right here, remember, we're never taking a short trade till we breach the 50. The 50, the trend line is just crossing the 50. Exponential, just crossing the 50. And we know we've got one quant. We've got both Laguerres, mandatory. And on our higher time frame, we've got no resistance. We're in this zone right here. We're between here and here. And we take the trade, up we go. Now that's a trade that takes a little bit of experience to do, but that's exactly the kind of trade I took. And we'll go back and I'll show it to you. Now, most of the time, we don't have to look at two time frames. When you don't have to look at this. When you have dark green, forget about this. When you have dark pink, forget about this. But on this transition zone, or to see what direction you want to trade most accurately, it'll help you out. It'll help you out. So let's go to plots, text and markers. Go to the transition zone trade. Right here. Now this was at 9:35. Let's go to 9:35. And there's the zone right here. Actually, what I did was, it really wasn't a transition zone. We just had, now for some reason we did not get background bias. We had a perfect trade short here. And the reason we didn't have background is, I didn't go into the minutia. I hope I'm not confusing you, is that this line was yellow and not red. And let me make sure I'm on the right day, because that seemed like we should have gotten it, but we didn't. And it was right here. But we did not have background right here. And we didn't get it until this line turned red. Now, we're dealing also with a recalibrated chart, but that was the zone I took. Not really a transition zone, but a zone where we had no downside resistance, or no downside support, all the way to here. So I was trading all the way up here and down. Now I know it's complicated when you start taking trades like this, but I wouldn't worry about them. Here's what I would be concerned about. I'm just going to double back. On the resistance on the higher time frame does in the volume zones, Thomas, but the higher time frames do not show the 50 or the trend on the higher time frames. Those you have to look at yourself. So you do get a pivot resistance on the higher time frames as the zones, but the 50 and the 15 you do not get. Now, it's real, I mean, you can really, as a beginner and someone who's just trying to master trading and just become profitable, you can forget the higher time frame altogether and just trade pink background with dual dots, dual quants, and dual gears. You know what's going on the higher time frames when you have that color. And looking at the higher color is no longer important. When the background is green, you know what's going on the higher time frames. When it's clear, you may have a potential transition zone, but I'll call them for you and show them to you. Don't worry about them. Just master the trades when the background bias, like this, is dark pink, candle halo magenta, dual quants, dual gears, no downside support, upside resistance, and I'm telling you, you're going to get great trades. Later, you can look at that more complex transition zone. It's still a riskier trade, and one that you don't even have to ever take to become profitable right here, because they're going to come when there's no background, and they are obviously riskier. But they're good trades, but they can blow up on you. So stick with these kind of low. I mean, this trade at 928 is one of the best trades I've seen in months. Now, it's a quick trade, but it is not too fast to get into. You break the pivot here, Now, if you don't have a pullback candle wick inside here, you can't take it. You have to take a break, but you need a pullback. Here's your pullback, and it's right to support. When that wick comes right into the trend line here, and your separation is here, and you've got dual quants, dual Laguerres, I mean, you've got yourself a ride. Now, 100% of these won't work, but 85 to 90% of them will. I mean, we could have finished with 2 full winners and 600 if I would have traded this at 928. That was just an incredible trade. So just focus on these. I'll call the transit, but this is what I'm looking for. This is our bread and butter trade, and that's what we need to wait for. And they come every single day. If we go to the NASDAQ, which moves a lot faster, and that's the reason I don't trade it, because it's hard to call a trade and have everybody in the room get into it. I mean, you're going to get 1 ton of trades. Right here is a trade, and it's a nice winner. You're going to get winner, but here's your sweet spot. Dark pink, dual Laguerres. Now, you don't have the long-term Laguerres. You can't take it. But here's your winner. Kaboom. Now, this might be a full winner. This is a 4 Unorenco. This is 4, 8, 12, 16, 20. It's not going to make it. That's 21, but you got to subtract. That's 20 ticks. Our second target, 22. It wouldn't have made it, but it would have come close. Now, if we got a pullback here, take it out at support, close the trade, and forget everything in here. There's your next break. Now, again, you don't have the Laguerre, don't trade it. Too risky once you're up this far. And here's your trade. Now, with the wicks, do not recalibrate. Ninja won't hold them. But if we got a pullback, we're in and up. So I think you got a good feel for what we're looking for. Now, let me make sure the long-term Laguerre, I'm sure it's set right. It is. Remember, these recolor, unfortunately. Multi-time frame assessments. One of the reasons Ninja Trader kicked us out of their ecosystem is because we blame them for the recoloring of the multi-time frame assessments. And we know it's their fault, and they want us to say it's ours. And they got mad at us, send us an email, told us to stop saying it, and we won't. So they threw us out of the ecosystem, which I don't care. But that's the reason. If you hit F5 or do anything inside the platform, when you're trading it, you're going to lose the wicks, and all the multi-time frames are going to shift to the right. So it's going to be a little bit tougher to see whether you have a trade. Off the right edge, you're always correct. See all these wicks? We know. As we were talking, we just had a full winner on the NASDAQ. There's your break. That's enough of a pullback for me, and I'd be in, and away we go. I mean, we're looking for 22. This is a huge trade. It just took place since I opened the chart. I mean, this is just an estimate when I scale it, and it's maximum excursion. It's 15.5 points. At 62 ticks, approximately. We're looking for 22. Now, we could have gone back in here, right here, but it's risky to go in again. It's possible, and you may want to give it a shot, but I wouldn't recommend it. but you can. But it's a huge move. Now, what we're looking at is exiting on the change in color of the trend on the runner. If we do, we would have gotten on this trade an enormous winner. I mean, we would have been in here and out at the close of this candle down here. Would have gotten 39 ticks. Beautiful runner. So that's what we're looking at. But just stay conservative right now. Don't worry about anything else. Careful on the light blue. Study carefully the magenta because and the bisque, because they may give you nice trades, but this is your sweet spot, and now you know why. And this is what we're looking for. So let me see if there are any questions. Oh, now, you know what? I'm going to do stocks and Forex tomorrow because I swear I'm just talked out. And I'll hook up the stock feed and the Forex feed tomorrow. Now that you know all the indicators, I will go look at any Forex pair you want, and I will look at any stock that you want. I have an FXCM data feed, and I have a TD Ameritrade data feed. The TD Ameritrade data feed will give me any stock, and the FXCM will give me any Forex. So we'll look at knowing how the system works and knowing what we're looking for. Now on Forex, we're going to trade Unaranco. On stocks, we're going to trade time. So we're gonna bring in the stock template, and that's a time-based template. Now let me I'll look at Robert. I'll look at any Forex pair you want. Okay, it does not matter. I'll look at them all for you. No problem with that. I can dial in them all. I can dial them all in, and I'll look at every Forex pair that you like. I'm honest to God, I'm just kind of talked out, and I haven't had any lunch. I'm getting hypoglycemic and shocky here. So I mean, if I traded all afternoon, I would definitely have to take a lunch break. But I think now that you know the platform and you have a little bit of time to ingest it and look at it, tomorrow we'll do all the stocks and we'll do all the Forex. No, I fixed it, Sergio. Sergio just came in now. He must have been doing something. So let me just go through if there's any questions. Okay, I'm glad it was informative because I really want you. I showed you Thomas, tomorrow we're going to go to stocks. We're going to stocks and Forex. And we'll just look, I'll look at any stock you want. We're going to pick the time frame based on the volatility or what you want. I mean, if you want to trade on Netflix on a 2-minute, we'll do it. It's whatever you like. But you know what we're looking for now. And you know when the sweet spot is. And we'll look at any Forex pair you like. And if you look here at our templates, we have the pound Canadian, the pound yen, the pound New Zealand, the pound dollar. We have more templates too. We have a lot more. Here's the pound yen. Here's the dollar Canadian, the dollar yen. We've got them all over the place. We've got almost every Forex we need. So we can look at all the Forex. The stocks, all we have to do is change the quant, which we'll do for each stock that you want. And it's easy. So let me just see here. No problem, Robert. We'll go over all of them. We'll go over the Aussie, the Kiwi, the Canadian, no problem. Could you do like an LABO? Don, I'm not sure what an LABD is. Can you just explain it? Really funny. Want to send me a yes, Rob. You send a pizza to Miami, Robert. I'll give you the number. I'm just kidding. You're really funny, Gus. Thank you, Gus. Listen, I'm going to have this cut. So, and I'll leave the trading session in because it's only 15 minutes, and I'll have it sent out to everyone who's in the room. So you'll have it on a link, and if you want to review it, you can review it. I'm 200 pip up, nice on the pound dollar. Listen, I like Forex, and if you trade it on the NDT, I really like to take a 1 pip pullback on the Forex. And you're going to see how well the Forex trades. Trades really well. So do stocks. I just don't know what that LABD is, Don, if you can explain that to me. You know, Thomas, if we don't have a template, we'll build one for you, because you can trade ETFs on here. And building templates, building quants for ETFs is really easy. So if we don't have the quant, in 48 hours, we'll have it for you. And a commitment we make to you is, if you want to trade an ETF or a stock and we don't have it, we'll build it for you. And we don't charge you $1.98 for quant. It's just part. We just give it to you. Hey, Francisco. Listen, every time we make a change, we update the templates, and unfortunately, they're often. I want to stabilize the platform, and look at this area of consolidation right now. But every time we do, we send them to you in a zip file, and if you can't insert them, we do it for you right in here. Look at this. Now that's consolidation. Now when it breaks out, it's likely to break out big time. Now on NASDAQ, you can see the background is blue. We know we can only trade long. Now it's the volume is lousy, but there's your long trade. You already have a winner. I mean, the first target's only 10. The second target's 22. Now, whether or not it's going to go all the way to 22, don't know. But we're trading with kind of crappy volume. It looks like it's trying. No, it's not going to make it. You're going to get one target, it looks like. That's it. Now, I'll just show you really quickly crude. Crude is going to pieces. Look at that. I mean, I would take this trade right here. I mean, this is just a freaking incredible trade. Look at that trade. And you don't have to look at multiple time frames. And those trades, I'm telling you, 85 to 90% of those trades are going to work. Decent volume. Now, I bet it was a lot higher on this move down. I mean, crude is moving. I can't believe how low it is. It's incredible. But that's a $220 trade on 2 contracts, the way we have the ATM. Now, if it's $10,000 of margin per contract, that's going to be a problem to trade. But you can see when you get the alignment and the break, you just have the trend separating. And as you go down, the trend separates more and more and more. And you get a beautiful trade to the downside. You know what, Don? I believe we have an ETF biotech. Sergio's got a whole file of them, and we'll roll them out for you tomorrow. I'll have them on my workspace, and I'll show them to you tomorrow. I'll show you everything. Whatever you want to see, I will put up. Okay, Robert, that's okay. We can afford a pizza. I appreciate it. You know, I have a very light lunch because I have a tendency to get heavy. And right now you can't go out. All the gyms are closed. Everything's closed. We're on lockdown. And so like I tend to eat like very little because I'm scared of getting too fat. I don't think I'm fat, but I don't want to get there. Hey, he's taking shots at Los Angeles Police Department. I don't know who that is. Oh, it's the biotech sector. We'll show it to you tomorrow, Don. And I believe that we have a quant for that. My pleasure. My pleasure. It's the same, Scott. Scott asked a great question. The Globex currencies as opposed to Forex. You know why it's the same, Scott? Big money moves everything. And what we're looking for, our whole workspace is based on the premise that these multi-time frame alignments do not occur without the participation of institutional money. That you saw this move up on the NASDAQ, it just shot up. When you get this alignment, it just goes. And you'll notice we don't care about Japanese candlestick formations. We don't care about oscillators, divergence. We don't care about fibs. We don't care about Elliott wave. All we care about is these multi-time frame alignments and trend, and they are created by big money. It's the only thing that can do it. Now, I'll show you something. If you took the NASDAQ and squeezed it today, you could have, now remember, the background bias is not set. The candlesticks the Unorenco are not set for a swing trade. But you could have had on one contract, you would have seen that institutional money was just driving price constantly lower. And look at the sequential lower highs and sequential lower lows. Just tells you. Now, if I redid the background, changed it to a much higher, you could have gotten a great short trade. And here, just a terrific long trade. And there's no reason you can't swing trade with one or two contracts on a longer term time frame. A lot of traders do it. We're just day trading, but you can most certainly swing trade. And I just wanted to show you that. And there's no difference, Scott. Let's see crude. Yeah, see, crude pulls back, no matter how bad it is. It has that desire to pull back to mean. Now, mean is constantly falling. So here's a trade we can't take. Well, we could take it. There's another winner right there. Once it hits mean price, you can recalibrate yourself and you don't have to worry. But if we squeeze this chart again as a trend the whole day, every time it hit this area of resistance, look at this move down. It's definitely doable. You got yourself an awesome trade. That's hundreds of ticks on that trade. Only, just the background bias and everything isn't set up for it. And I've looked at trading off of these areas, these big areas of resistance, the multi-time frame ones. And when they include a pivot, they're really tough to break. You see all the regular pivots just snapped. And everything went down. Now, if you traded a longer time frame, you probably wouldn't even have had these zones. But you can do it. And there's always that desire to retrace to the mean. Always. It'll be present in any market on any time frame, no matter what we do. Just a mathematical, it's an axiom. Like A squared plus B squared equals C squared. As an axiom, the regression to the mean is an axiom. Always going to take place. And look at crude pushing up like a Looney Tunes. This thing is crazy. Now there's a lot of potential for profit here, but a lot of potential to get beaten up too. But these short trades are just stellar. This one we couldn't take. You see how when the trend line is way above the 15, the trade doesn't work. When the trend line is right snug to the candle, just below the 15, the thing rocks. That's why this trend line is so important. Yes, it'll cost you winners, but boy, will it really work to save you from taking losers. And that's all that matters. You're killing me, Robert. Thank you, Don. My pleasure. Thank you so much, Kenneth. You should check that oil would go. People are called him crazy. I'm trying to paste you the link. Hey, listen, a lot of people called oil short. I read I told you, I read yesterday in an article that I saw in Benzinga that they believe it's going to take 2 or 3 years for oil to come back. And all the perma bulls in oil are getting murdered right now. And don't think the traders have not taken the US so long, thinking we've reached a bottom. And we just have not. We could reach a bottom at $5 for all we know. Hey, Steve. Thank you. Great session. Thank you, Steve. I mean, I really want you to understand. And when you really get good with the platform, you're going to be anticipating my entries. I mean, you're going to have your finger on the mouse ready to take the trade before I even call it. And a lot of guys in here do that. I mean, you're going to see great trades. And if I miss one, you'll be in it. And also, I don't trade pre-market. You get a gorgeous setup pre-market, pink background. I don't have to go back, but I mean, there was like a killer trade pre-market today. Right here. You're in. And up you go. Hey, Bharat. Bharat, the swing trading is exactly the same as the day trading. It's just on a higher time frame. And what I recommend on crude oil is you multiply everything by a factor of 5 or a factor of 10. So let's say you want to swing trade crude. If you multiply by a factor of 5, the 5 times 2 is 10. You're going to keep the ratio the same. 5 times 5 is 25. And 5 times 10 is 50. So let's hit OK. And the chart's going to recalibrate. Now, the background bias is still not going to work. But you can see, we can even take a longer time frame. You're getting, these are huge moves. I mean, this move up here, if you do this tick, and I'm just estimating here, that's 236 ticks. And you have to take it tight off the 50. But everything is still the same. Nothing changes. So it's up to you as to how much you want to change it. But you just multiply, you keep the ratio the same. And you multiply it by the factor that you want to change, and when you tell us, we'll give you the template. Because the swing trading entries are identical to the day trading entries. The dual dots, the background bias. I mean, it doesn't matter what time frame, Bharat, you're still looking for those exact same entries on that multi-time frame assessment. When you get them, you can ride it for 100 ticks. So that's up to you. I mean, the E-mini today, I think you could have gotten 40 or 50 points. Hey, Joseph, do the resistance support levels use level 2 data? They do, Joseph. They use level 2s. Hey, Scott, what do you mean by mean? I'll show you right here, Scott. Listen, the 50 is the average price of the last 50 closes. That's what a 50 period moving average means. It means this is the average price that the market closed at going back 50 candles. So it becomes mean price for our software, for our platform. And there's always a desire for price to push back to mean. So as you move off of mean, this is what really determines overbought, oversold. It's not an oscillator. It's simply as you price pulls farther and farther from the mean, that mathematical pull back to the mean becomes stronger and stronger. That's really all it is. And it's an assessment of risk. You can see this trade short here. Look at the space between the 50 and the trend and the 15. So tight. And this is what we really are looking at right here. I'm going to put a little triangle. This space here. That defines how far off of mean price we are. And if that's tiny, that's the best time to trade. Now, we don't have a setup here, but it's unfortunate, but we just don't. We're not always going to get one. But this is a great trade in terms of trading off of mean price. Now, why can't the mean be the 100 period or the 200 period? And it can be. We just chose the 50 because of our day trading. If we were swing trading, we might choose the 100 as mean. I mean, really, in my opinion, and I can show you the mathematical modeling behind it. The key moving average of the 15, 50, 100, and 200. And I'm telling you that there's a mathematical reason for it. And I actually made a video about why, but I'm not going to show it because it's getting really late in the afternoon. I'll show it to you tomorrow. I think you'll find it pretty cool, but it's going to show you why the 15, 50, and 100 and 200 are really unique moving averages. Because if you think about it, there's an infinite number of moving averages. What's wrong with the 49 period, the 48 period, the 47 period? There's something unique about these moving averages, and I'm going to show you what they are. I'm going to show you why I chose them. Nothing, I swear you, nothing on here is random. Everything's been chosen for a reason. Hey, Robert. Robert says, shush already. You're cracking me up, Robert. One day you're going to unmute me. I'm never unmuting you, Robert. If we unmute the whole room, we're going to keep you on mute. Oil can kiss my butt. I'm not going to read that, Robert. I'm not going to read that, Robert. Hey, Chris. Well, we're not going to, I don't know what you mean by red, green dots, Chris. I mean, we're not a red dot, green dot trader. We're going to have a revolutions entry to really make us look and say, hey, is it a perfect entry? I want to take it. It's still going to be a discretionary trade, but everything that I talked about is going to align, and it's going to save us work. And with an audible alert, it's going to allow us to look at more markets than we can now. Name of the indicator, it's going to be called the Revolutions Indicator. I don't know where I got it from, and we had it on here, but it was so inaccurate I took it off. It just wasn't any good. Let me see if it's still in the package. It may be here, but it just was. It didn't look it enough. Sergio took it away. We'll bring it back. And don't worry, you'll all get it. You have the software, you get it. Don't worry about it. Do you use or instrument settings? I'll show you. If we look here, we use the use instrument trading hours. That's a good question, Robert. That's what we use. No, my pleasure, Bharat. Josh, why won't the background work when the workspace is scaled up? It will, but remember, right now we have the background bias set to a 2510. When we go to a higher time frame, we have to change the background bias in settings to do different multi-time frame assessments of longer time frames. It will absolutely work. We just have to modify the whole workspace. Remember, the dots have to be changed in speed. The quants have to be changed in speed. The multi-time frame gear has to be changed in speed. So what we have to do based upon, oh, look, the crew is going crazy. What you have to do is decide on what you want to trade, and then we'll build you a template. And that template will have everything recalibrated. Most of the recalibrations you can do yourself, but we need to help you out a little bit. And all you're going to do is just go to template and dial it in, and you're going to load, and it'll say swing trade, swing trade or STCL, ST E-mini, ST Google, ST Euro Pound, and we'll create the templates for you. But everything has to change. We don't get any automatic change on the multi-time frames. Yeah, listen, I mean, we could swing trade, but there may be 2 or 3 days where we don't get an entry. And if we're really careful with our day trading, we can make 400 to 500 a day. I'm telling you, on this volatility, you just have to wait. Well, we haven't created the template yet, Bharat, but if you want, we'll make it for you. Just give us a couple of days, because I want Sergio to get that revolutions indicator out, and then we'll build your swing trading template. You just have to tell me what market you want to swing trade. Because remember, swing trading crude and gold is going to be different than swing trading the NASDAQ and the E-mini. I mean, they have different volatilities. So you have to let us know what you want to swing trade. If you want to swing trade them all, we'll make you swing trading templates for all 4 markets or 5 markets, but just let us know. Hey, Frank. The NDT does not come with it, Frank. But if you buy the software, you get it at a huge discount, simply because it has nothing to do with the software. I mean, it's a trade execution tool. And I don't sell in this room. I don't do anything. But I really recommend, if you want to trade, you should. It's a lifetime ownership deal, and it's very little money, and you should get it, because it's such a great tool. If you trade time or tick, you don't know when the candle's going to close. So you just hit on this, close on a down close or buy on an up close. It finds the close for you. And if you have to run around on this crazy thing, you're going to go out of your mind setting a buy stop or a sell stop in this kind of market. It's just too nuts. I mean, this is the E-mini. You want to trade crude to the NASDAQ, you're going to have a real problem. So I would just recommend it. Hey, Enrique. Sure. Okay. We'll email the swing trade templates out in a link, but you have to give us a few days. But we'll give them to you. We'll do it on the futures. We'll do it on the futures markets. Later, if somebody wants to swing trade stocks, we have to look at the volatility of the stock. And later on, we can also look at a swing trading template for the Forex. No problem, Scott. You are special, Robert. Come on. The very large dot, that really wasn't, well, that's our, you should have it. The large dot, if I can find it again, of course, when you look for it, it was on the E-mini. It's called the continuations signal. I'll show it to you, and you should have it. I kind of ignore it because it's not that great of a signal. But if you do get it, I mean, the ones I showed were terrific. Just don't know where they are. Let me trudge to one here. I put it up and it showed like absolutely unbelievable entries, and I can't find it anymore. Let me see if Sergio put it in this template. It may not be in here. No, it's here. I just can't find this. It's called the continuation signal, and it does do a multi-time frame assessment, and it's really not a dot. Look for a bar, and you will see it eventually. It doesn't come often, and the way we have it, it's easier to miss, unfortunately. Let me just go through and see if I can find one. It's nice. We just had two pop right in our faces, and now I can't find it anymore. I don't know where it is. Oh, let me look at the E-mini. I know it's there. There it is. Now that's a good trade. It just doesn't go. See that trade? This is how we have it formatted. It's a great trade. Now, we do have the ability to take it. We have dual quants and dual years. We don't have background. We have separation. It's a discretionary trade. They're popping up a lot on the E-mini. We're just not getting it. Here's two in a row. There's your entry. We can't take this trade because the trend line is flat. But that's the continuation signal. We're going to replace that. And here's a trade. It's not looking at support. It works. It's a decent signal because it's a multi-time frame signal. But you have to be really careful with it. But I would take note of it. See here, this is just no trade. There's nothing here to trade. Here, it's a potential short off this up candle. And this is the one I pointed out as a loser. But it's right into support. You can't trade it. The other is going to take that all into consideration. But it's a decent signal. What are the dark, bold blue lines below some of the candles? That's the continuation signal. That's what they are. What we have them formatted is that way. Because we have enough circles, we formatted that as a bar. That's all you see. It's a square, 10-point square. That's all. Hey, thank you guys. The different color halos is order flow. That's the halos. Hey, Stan. Absolutely, Stan, you can. You certainly can. Hey, Bharat. Okay. Well, if we do the E-mini, which is what you want, we'll probably do the NASDAQ as well. And I think we had a request for some other markets. We'll do a few of them. Hey, Frank, is there a way to do a buy or sell on close? Either way, yes. See, you can, where is it? See, buy or sell on close. Just press that button. Right there. And that's for Renko traders sometimes want that. And that's going to buy or sell. on the close of the candle. If it closes to the upside, you get a buy. To the downside, you get a sell. And the other thing that's on Sergio's list that I hope will be out within the next 2 to 3 weeks is we're going to do OCO orders. We're going to program the NDT to take a bracket trade. So you can now put in a long trade and a short trade. So in crude inventory, if the long trade gets triggered, the short trade will cancel. Because we had so many people ask for OCO orders that it'll give it the ability to bracket trade. Seriously, the indicator, everything is aligned. Okay, Robert, I don't like to name things after myself. Okay, hey, listen, guys, thanks so much. What about showing profit while in trade? Well, we could do that. The only way to do it, though, is to show the chart trader. And honestly, I don't hide it because I show it to you at the end. And the only reason I don't is because it takes up too much space. Like if you do this, let me just do this. And then you have both of them showing. Right now, I'd like to have all the room for the but if we let me see, where's chart trader here? It's right here. If we open chart trader, it could show you a running P&L. Sergio could configure it. I'm not going to bother to go into it now, but he could have it look. Only it takes up so much space and squeezes the chart. That's the only reason I don't project it. Oh, on the NDT, you know what? That's something we can easily do. The first thing I want to do on the NDT, though, Frank, is to do the OCO order. Because a lot of traders want to bracket trade news. And it's something that we might even do on something like crude inventory. I mean, we would experiment with it. So I think that an OCO will be first, and then we can show that. I'll just tell you this. I don't have any JPEGs of it. They're behind, but we used to have on the NDT, this is what the NDT used to look like. This was 2 or 3 years ago. It looked like this. It had a dome, and it had the price moving up and down, and it showed the profit loss on every trade. And we got a letter from Ninja saying they were going to sue us for copyright infringement or patent infringement. So the only way we could stop them from suing us was to chop the dome off. But when we first rolled this out for about 2 months, we had the whole dome. And if you go back to 2014 and early 15, and you look at my videos, you're going to see we had this rolling dome. And we had the profit in here accumulating per trade. And then at the close, it showed you the total profit loss for the whole day. But we had to chop it off. Because I'm not fighting with a company that big, and we would probably lose. So that's why it's only an execution tool and not a complete dome. Because they told us to either put the guillotine to it, or they said there's a warning letter from their attorney, so you don't take those lightly. So we had to chop it like that. Okay, I just want you to know that. But we can add that value in. Did the dome look unique or look like? No, it looked very unique. You know what, Jeff? If it wasn't almost 2 o'clock, I have JPEGs of it on my workspace that are like, from 2014 and 15. And I'm not going to go look for them now, but I'll show them to you tomorrow. I'm telling you, it looked different, but it really did look like this. I mean, how else can it look? It had to have price, and it had the market, and it had all, all these buttons on it. So I'll show you a JPEG of it, but we can never have it because they'll come after us. No, listen, I'm telling you, they're a menacing company. I just don't want to deal with them. I really don't. I know. Listen, I would love to put it back, but we already got our one warning letter. The next letter we get is a process server and a lawsuit, and it's the last thing I need at this point, at this stage of my life, is a lawsuit from them, and we can't win it. So all we can do is settle, and then you're probably going to ask us for $25 million, in which case I'm going to have to move the company to Czechoslovakia. So I really don't want to. I don't want to mess with them. Yeah, the Turks and Caicos. I moved to Cyprus. That's where everybody who does everything, and you can't reach them. But I would really love to do that. Well, we had the dome, and the dome. I'm just going over that. We did have the profit loss, and that's where we can bring it back fairly easily. But I want to do the OCO, and then we can do the running total on the trades. So listen, everyone, have a really, really great afternoon. I hope you really learned a lot from this. You're going to get a link to, if you want to re-listen, if there's any part of it that you want to take, review. It'll be there always for you to refer to. And tomorrow you can record too. I will record as well. We're going to go over the Forex, and we're going to go over the stocks. And crude is moving lower. Look at this. It's now $9.70. Holy God. And the data feed just froze. When it opens, it's probably going to fire down. This is unbelievable. This is like a massive, there's the low a day. It's just like it's not even there. Crude is frozen on too much volume. Look at that. Well, listen, everyone have a really wonderful afternoon. Let's come back tomorrow. Let's hit it hard, but not rush. It's patience and it's I'm forgetting the other word. And really being diligent in adhering to our rules. And if you have that, I'm telling you, you're going to make money. So have a wonderful, wonderful afternoon. And someday when crude unlocks, we will see. It's probably going to finish at $2.34 a gallon or a barrel. It's unbelievably. I've never seen it so cheap. But remember, the market always overshoots, so it's going to get too cheap. Only God knows when it's going to recover. So take care, everyone. Have a really, really great afternoon. I'll see you tomorrow morning. Bye-bye, everyone.